In just moments, Anna Bremen fronts her first big OCR call as governor of the Reserve Bank of New Zealand. And on paper, it looks really simple. I think almost everyone out there expects the OCR to stay exactly where it's at 2.25%. But I want to shine a light on the power struggle over expectations that was well underway late last year. The Reserve Bank has been saying that rates are likely going to stay low for all of 2026, maybe even another cut. But all the while, the big four Australian banks are out there talking about hikes this year being more likely than not and mapping a path all the way back to a 4% OCR over the next couple of years. Now, if you have a mortgage or if you're one of the many Kiwi households that are desperate for some relief, or you simply just need house prices to stop falling, that gap between the retail banks and the Reserve Bank matters a lot more than this week's headline. So in this one, I want to unpack two different stories about what's going on. The one most economists will believe in, and the one I think better fits the world that we're actually living in. And then I'll share how I'm handling my own interest rate risk with a big 5-year fixed rate loan coming off in May. My name is Darcy Angaro, though, and I'm a financial advisor here in New Zealand, and I work with everyday investors who want to think a little bit deeper about how money actually works. And I'm not here to tell you who to hate and what is right and what is wrong necessarily. I'm here to help you see the setup that we're in right now as it relates to interest rates and potentially property values in New Zealand. And there are two stories going around, I think, about why the banks are calling for higher rates while the Reserve Bank of New Zealand is talking flat. Both sound reasonable on the surface, by the way, but only one lines up with what's happening in real Kiwi households, I think, and also with what's happening in the world in terms of a shift away from a free trade like world to one where banks play a more prominent role. But first, let's set the scene and then we'll get into those two stories. Most previews say that the Reserve Bank of New Zealand will hold the OCR at 2.25% at this first review of this year. That's the easy part. The tension, though, is what happens after that. On one side, though, you've got Dr. Anna Bremen, and I think New Zealanders will actually fall in love with her over time because she understands where we're at in a global context a lot more, I think, than some of our local economists, because that's just our culture. The more you live here, the more likely it is that you start to drift away from understanding what the world actually thinks, and you end up clinging to a version of the old world that you used to know. And I think we're at a point in time where we need to start electing politicians who are brave enough to bring us back to the rest of the world and not just feed what we've always wanted for in the past. On the other side, though, you've got all the major bank economists on TV and in the papers. Do we really read the paper anymore? Or in just publications, mainstream publications, saying that hikes this year are likelier than not. And Westpac is now penciling in a track that takes the OCR to 4% by the end of next year. So all this is happening against a pretty ugly economic backdrop. In the December 2025 quarter, about 165,000 New Zealanders were officially unemployed, pushing the unemployment rate up to 5.4%, which is the highest in a decade. The underutilization rate, or the people who want more work but they can't get it, is hovering near 13%. And across all credit types, close to 500,000 New Zealanders are behind on some sort of mortgage or debt repayment. That's from data that's almost 1 year old. So while all the talking heads debate whether the next OCR hike is in May or December or whenever, there's a chunk of the country that just wants one thing, and that's relief. And some of those people also need house prices to stop sliding. But if house prices keep on drifting down as interest rates keep staying at current levels, equity will start to disappear from the everyday homeowner. And that creates a problem not just in people's wealth, but it creates a problem in society. And that might be quite influential in terms of determining who gets into power at the next election. But sitting on top of all this stuff is a banking sector that's doing just fine. So you don't need to worry about any of this. In the most recent year, New Zealand banks collectively made a record of $7.2 billion in profit. And they did it with net interest margins that are high by global standards. And net interest margin, by the way, or NIM, is simply the average gap between what a bank charges borrowers and what it pays savers as a percentage of its loan book. Profits are all relative, but the amount that they make for each dollar that's being lent out, that's what we need to be measuring more than anything else. And New Zealand's biggest bank, though, just for perspective, runs a net interest margin of about 2.6%, all the while its Australian parent group will average closer to 1.5 to 1.8%. ANZ's latest quarter showed profit surging again now on even fatter margins and lower costs, with their margins ticking even higher after policy rates started coming down. So you might be dealing with the same bank on either side of the Tasman, but if you're dealing with them in New Zealand, you know that they're going to be clipping an extra 1% on every dollar that it lends you. Now, regulators, including the Reserve Bank of New Zealand, say that they want a stable financial system. Now, in practice, it seems to involve banks that don't rock the boat and banks that keep earning tidy, reliable profits. And it might be great to know that there are always lenders out there that are willing to issue credit, but just consider this. Does it sound like the setup that it's designed to get borrowers the sharpest deal on their mortgage? So that's kind of painting the scene. But now I can share the two stories that might help explain about where interest rates are going to go from here. The dominant paradigm in economics has come from one man named John Maynard Keynes. In the 1930s, during the Great Depression, one view was that if markets were left alone, they would eventually self-correct. Unemployment would come down by itself, and demand would magically pick up. Keynes looked at mass unemployment and he said, yeah, that's not happening. And in his 1936 book, The General Theory of Employment, Interest, and Money, the theory went somewhat like this. What really matters is aggregate demand, the total amount of spending by households, businesses, and governments. If demand is too low, you can sit with high unemployment for a long time, but there's no automatic spring that snaps you back to full employment. So the state should step in bad times and cut rates and increase government spending to boost demand. In good times, they should tighten the policy to stop inflation from getting out of hand. Post-World War II, this framework was adopted by a lot of Western countries, and governments and central banks started to see it as their job to manage the business cycle using fiscal, taxation, and monetary, interest rates, levers. Spend more when things are slow, pull back on the spending and raise rates when things are hot. And for a few decades, especially in the 1950s and in the 1960s, it seemed to work pretty well. Growth was strong, unemployment was low, and the idea that clever people in suits could smooth out the bumps became the default belief. And fast forward all the way to today. And most bank economists, most politicians are still operating inside of that framework. High inflation is treated as a sign that the economy is overheating. It's too successful. If the economy is overheating, then you need higher interest rates to cool things down. If you don't, you risk an inflation spiral and a messy crash later on. So it actually makes sense for them to say things in the media like the OCR should start rising again from late 2026. Hikes this year are more likely than not, and borrowers should think about fixing longer, which is what they've been saying. In other words, story one is that the banks are being responsible Keynesians. They're just acting rationally based on their belief set. They see a risk that the Reserve Bank of New Zealand is staying too loose for too long, potentially right now. And they're drawing attention from the normal data that they would use to more high frequency data to find more evidence that the inflation risk is a little bit stronger than what maybe the RBNZ is saying. Another way you could look at it is that they're trying to nudge policy back towards where, in their textbooks, it should be. Now, if that whole story is right, and that's a big assumption, I think, then the banks might be early in being worried about inflation coming up, and they might be wrong on timing, but they're not acting in bad faith. They're just doing whatever the model says you should do or should be done under these circumstances. But here's the question I think that we're missing, and the question that we need to go back to. Is the Keynesian view really still the right lens for where the world is going and the world that New Zealand is increasingly finding itself living in? If you want to learn more and take a deeper dive with me on this topic, then check out this video. I'll put a link to it in the show notes where this is exactly what we talk about. But I want to talk now about story two. Instead of assuming inflation comes from an economy that's too hot, this view starts with a really simple statement, which was best made by Milton Friedman.
Inflation is always and everywhere a monetary phenomenon.
Too much money chasing too few goods and services leads to inflation. Now, I would add to this a little bit of a structural shift in terms of how geopolitics and banking has evolved over time. In 1971, Richard Nixon effectively took the US dollar fully off the gold standard, ending what was called the Bretton Woods era. And we've been living in a fiat currency type monetary regime ever since. But from that point on, money and credit could expand at a much faster rate than the real economy was growing. And there was no hard stop, no limit to this. And they could get away with it as long as people didn't lose faith in the system. Now, technology has been with us since the beginning of time, but it's really grown exponentially in the last 100 years. And in the last 10 years in particular, it's grown at an even faster pace again. And in a world full of technology, the natural state, therefore, of prices is downwards over time. And I covered that in another video a while ago with Jeff Booth, and you can check that one out. Again, link is in the notes. But unless you actively, as a central banker, fight that deflationary force with stimulus and new credit, then the economy goes into a deflationary state. So, seen through a Keynesian lens, that deflation is viewed as a stagnating economy. Is technology that makes our lives better signs of a bad economy? Well, it is for some people, that's for sure, but not generally. This is the problem with the new world. What do we define what success is when we have a K shape that's unfolding all around us? So, seen through that slightly different lens, the last 5 or 6 years of monetary policy in New Zealand can now be interpreted a little bit differently. From 2020 onwards, even before the pandemic kicked in, the Reserve Bank of New Zealand opened up the taps with emergency low rates and later with large scale asset purchases. There was a clear signal that money would be cheap for a very long time. The banks then pulled that cheap liquidity through the system via mortgage lending, and a lot of it went straight into property values and eventually other types of assets too. It didn't go into anything that was genuinely productive. That's not just a New Zealand thing. That's something that we saw almost in a coordinated fashion happen all over the world. And surprise, surprise, the asset prices and some consumer prices took off. Now, none of that was a natural boom from an overheating economy that needed to be cooled down. It was a policy driven bubble that now needs to be worked off. And it takes time. If you think about how much new credit was created, how much new borrowing the government actually engaged in and then put to work in really non-productive things, we have to pay all of that back basically. And that's going to take time for that to flow through the system. Again, staying in this mindset, in that world, keeping interest rates too high for too long into a weak and uneven recovery doesn't look like responsible medicine at all. It looks like tightening the screws on the very households and small businesses that never really shared in the upside of that money creation in the first place. It's just another swing of the pendulum. And we've seen this before in different versions. Pre global financial crisis, the official cash rate was cranked all the way up to 8.25% in 2007. A lot of people thought that high rates were here to stay and they were even going to go higher. But within about 18 months, the official cash rate had plummeted to just 3.5%, which would eventually be dialed down even further to 2.5% as the global financial crisis really hit. But in 2014, the Reserve Bank hiked from 2.5% all the way up to 3.5% in the end. And again, the story was that rates were just normalizing and that they would probably actually go higher from here. Instead, the economy underperformed, inflation stayed soft, and the official cash rate was eventually cut all the way back to 2.5% by late 2015, early 2016. Now, in both cases, the peaks in rates were brief, but plenty of people thought that they would last. Many locked in long only to watch the official cash rate crash, and that ended up in triggering break fees for a lot of people that were selling properties and were locked into these long 5-year mortgages. They believe that inflation needs to be dealt with without fully recognizing that underneath, technology and global forces were pushing in the opposite direction. And those forces have been at work for a very long time, and there's no chance that they're slowing down anytime soon, in my view. So, through this lens, this cycle looks less like we need to hike to tame a boom right now, in my view. And it starts to look more like we've pumped too much credit into the system, and we're now at risk of being forced to keep interest rates high into a slowdown because we're using an old lens to see the world through. But let me finish, though, on what I'm actually doing, how I'm managing my own interest rate risk. And in May this year, we've got a very healthy sized mortgage, which is coming off its 5-year fixed rate term. And I was hoping rates would be a little bit lower right now. Goes to show that nobody really knows what the heck they're talking about. And you might be right, but it might take longer for you to be right, or you might be wrong as well. But I still believe that I will see lower interest rates. Unfortunately, right now, they're not as low as I was hoping they would be. Now, knowing what I know now, based on talking to a lot of mom and dad property investors out there, I think a lot of them are thinking about selling over the next 1 to 3 years. I don't want to be competing with that anyway. And my focus, therefore, turns towards managing interest rate risk really well. And that's kind of why I think about not just what reserve banks in New Zealand have done in the past, but what they might do going forward. And that's what gives me hope about this new Reserve Bank governor is hopefully we now have a little bit more of an international lens, which might pull us out of a bit of a myopic funk. But while this decision is approaching, I'm personally having a slight bias in my thinking towards a 6-month, maybe a 12-month fixed rate. I'm honestly not going anywhere near the idea of fixing for 2, 3, 4, or 5 years right now. Yes, they may go a little bit higher, but I think the cheaper, more affordable money might actually end up being the floating rate and even the 6-month rate if this sort of tussle between which way retail banks want to go and which way the Reserve Bank of New Zealand goes. If that continues, that's what I'm trying to position for. Now, I'm accepting that I might pay a little bit more in 6 months' time if I got this wrong. So I'm being a little bit realistic about where things could go if I'm not right. But I'm also keeping open the option to benefit if the OCR has to come down sooner than the higher for longer story. And lastly, in a perfect world, I'd like to stay in the market because there's no way that I want to quit just when things are going to get interesting with Reserve Bank policy. Everything always involves a bit of a lag, and I wouldn't be surprised to see a new rationale emerge for a set of justifications to support lowering interest rates coming up soon. It's happened in the past. See also Christchurch earthquake. See also one of the last lockdowns and the date of that OCR announcement. But could I be wrong? Could you be wrong if you agree with me? Of course. Maybe the bank's Keynesian read ends up closer to the mark. But in a world where technology is relentlessly deflationary for wages and where households are already stretched and where banks' margins are getting fatter even as the real economy wobbles, I'm more comfortable betting that rates won't stay this high for that much longer. Now, of course, this isn't financial advice. It's just how I'm thinking through my own situation. And if you're trying to work out whether you should exit, trim, or hold, and how to stagger your fixed terms so that you're not trapped, and you want to talk it through properly, I would very much recommend that you reach out to a qualified mortgage advisor. Reach out to me on social media if you want a recommendation. That's it for this one, though. Thanks for watching.
Special thank you to our show partners who helped make this possible. Thank you so much, you're awesome. SwiftX and Provincia, thank you again. Want to connect on social media? You can find me on X and you can find me on LinkedIn. Remember, some investment strategies or ideas can make you obscenely wealthy or wipe you out completely. It's hard to know from this and what's best for your world. So if you can, reach out for some advice that accounts for your own circumstances. That's it for this one. Catch you next time. I'm out.